Hey traders, Raghee here, and in this free recap video, one of the things that I mentioned to the folks here out at the San Fran workshop is that we would talk about some of the longer term time frames that I'm interested in with some of the downtrends that are organizing. And we're going to talk specifically about the S&P and crude oil in this video. Now, there's a couple ways you could go about trading what we're seeing, and that is, I think, what is an established downtrend in the S&P and what is a newer downtrend in crude oil. And by downtrend, let's first start with how I determine what that is. Take a look at the daily chart of the S&P, consistent lower lows, consistent red grab candles. Yes, the market staged quite a rally, but gang, here's the thing. We've had pullbacks in an uptrend, just like we're going to have bounces in a downtrend. So, if you thought every pullback in the uptrend was a potential reversal and weakness, right, then that's a different conversation. But I think most people knew buy the dip. Well, in a downtrend, these moves to the upside are just kind of turn them around. It's called sell the rip. And that's really kind of the psychology that we're dealing with here now. So what I ultimately want to do is remember that so far, all indications are that the volatility that we experienced October 10th and about the next 4 or 5 days after that, volatility by and large, usually, forget the recency bias of February, March, April, but by and large, volatility is bearish, okay? But you don't have to, necessarily be convinced of that. In fact, you may not even like the idea of my talking about that. But where can we take advantage of this? And the time frame that I've been liking, and by the way, this isn't a longer term commitment of the downtrend. This is simply where is their structure and where can we short this market? This morning, I was looking at the 2677 level on the downtrend here. 2675 to 2680 was an interesting level, and I was looking at 77. And what we did this morning in the chat, we had noticed that the 1 minute, let me show you something here. I'm going to rewind back just a little bit. Look at the movement we saw right after the bell. And this would have been right up in this area here. This was the consolidation. This was kind of the area right after the end of the clearing that we saw the market exhaust, right about 75, as you can see there with that wick to the upside. And then we sold off to about 45, okay? That's a 30 pip move, hitting the major psychological level. When I'm talking about taking trades off at 240, sometimes it can be something just as simple as that. Fade one minor psych and move to another, meaning say fade 2680 with a 2677 to 75 short and play it down to 2655 to 2653, stepping in front of the 2650 major psychological level. That's one example. The other example is, let's go back to the 240. If you take a short in the middle line of the wave, which by the way we saw back here, and we're seeing it happening again, your stop loss is on the other side of 2700. Call it 2703, 2705. The closer your short is to 2700 to 2700, the lower the risk. In other words, your stop loss is just on the other side of that. So the closer your entry is to that level, the lower your risk. This is a very reasonable level to look at a short. Now, in this case, 88 or even 80 is a reasonable level. But remember, the zone itself starts at about, as you can see here, about 2674 with the bottom line of the wave, 2673 and a half, all the way up to 2701 and a quarter. So that entire range. Now that has been by and large really something in terms of price movement that we would see on the daily time frame. So you could see just how important it is to understand that the volatility, the price movement range has been so much wider. Now, the other really popular question I've got is, Rog, what's the sitch with crude oil? Is it a downtrend? Crude oil is sitting at the 200 EMA right now on the daily. and that is a technically important support level. I think one of the main reasons crude oil hasn't broken down in a more significant way is not the hesitancy of the S&P market or the Dow or the Nas. I think equities are pretty convincingly weak. The reason we haven't crossed through the 65.5 level and the 200 EMA is because the market's waiting on November 4. What kind of rally might we get out of the Iran sanction reaction? And that timing, we don't have a level yet because it's still too far out, but that level is something to keep an eye on. All right, so that's what I've got going on. Those kinds of shorts, making the 240, maybe even the 480 a proxy for daily downtrends has been something that we've been looking at a lot. And another thing I'm going to talk about in the premium video, by the way, is the kind of rhythm we see 3 to 8 days out before the end of the month, and then what we typically see going into a new month in terms of that end of month reaction. And so we'll talk about that in the premium video, and also how that may be different moving forward because of the downtrend we're seeing. All right, I will see you all in the next update. And until then, thanks for listening. I'll see you next time.